In the previous video, we provided a detailed explanation of the fourth subsection of the first major category of the CFA standards. Now, let's continue our in-depth analysis using case studies to enhance our understanding. Let's start with the first case. This is about Simon, a trust investment manager. Simon enjoys having lunch with friends, which is not a problem. However, one day, one of his clients happened to witness him consuming a large amount of alcohol during lunch. After lunch, Simon returned to his workplace to continue serving his clients. But he was in a drunken state. Although this behavior is not illegal, it clearly contradicts his competence as a professional investment manager. Based on what we've discussed earlier, Simon has violated the standards. Next is the second case. Over the past 2 years, Hoffman has submitted over 20 reimbursement claims to the company. However, a significant portion of these claims appears to be exaggerated. This behavior clearly violates the CFA standards. The third case involves Brink, an analyst in the automotive industry. In addition to his work, he is a volunteer at a charitable organization. Now, this charitable organization has decided to purchase 5 new vans and invited Brink to serve as the coordinator to find suitable purchasing channels. However, Brink has a hidden agenda. He owes a significant amount of money to a friend who is in the car dealership business. Consequently, he decides to guide the charitable organization to purchase the vehicles from his friend and share the profit. Does Brink's behavior violate the ethical standards of the CFA? In this case, we cannot definitively say that Brink has violated the standards. For example, if his friend sells the vehicles to the charitable organization at a fair market price, then there is no issue. However, the key point is that Brink's friend sells the vehicles to the charitable organization at a price that is 20% higher than the normal price, and Brink will share the so-called excess profit with his friend. By doing so, it is clearly a violation of misconduct. The fourth case is about Garcia, a fund manager of a mutual fund that focuses on socially responsible investing. Garcia is also an environmentalist actively involved in related activities. However, during a protest, Garcia gets arrested. The reason for the arrest is for illegally trespassing a petrochemical plant because Garcia believes that the plant causes environmental pollution. In this case, which CFA standard has Garcia violated? Here, we need to consider the circumstances. If Garcia gets arrested for participating in the protest, it may be illegal, but it does not have a direct and significant connection to his professional competence. Since there is no fraud involved, even if Garcia violates the law, it does not violate the CFA's misconduct standards. The final case involves Rasmussen, a research analyst in the trading department of an investment management company. AIR discovers issues in the performance reports of the company's hedge funds, but the reports fail to reflect the decline. After reporting it to his superiors, he receives a response stating that it's not his concern. In this situation, Rasmussen reports the matter to the compliance department. However, the compliance department also states that it's not his concern. Although this case is an open-ended question, it can be considered from several perspectives. Firstly, employees need to understand and comply with the law, draw boundaries, and act in accordance with the prescribed procedures, even resign if necessary. If internal communication is ineffective, employees can report to external regulatory bodies. This is their right as citizens and does not constitute misconduct. Additionally, employees have a responsibility to ensure the proper functioning of the market by reporting to regulatory authorities. In this case, his reporting action does not violate his responsibilities to the employer and is in line with professional ethics. This case also reminds us to pay attention to the regulations regarding reporting gifts. Employees should report all gifts received, not just those from clients. This case involves several details, but the main topics that may be tested in the exam include knowledge of and compliance with the law, communication with superiors, reporting to external organizations, responsibilities to the employer, and responsibilities to regulatory bodies. Furthermore, it's important to note the concept of whistleblowing, which encourages employees to expose misconduct. Through these case studies, we have seen the specific application of ethical standards. In the exam, we may encounter similar scenarios. The key is to carefully read the questions and make judgments and analyses based on the CFA ethical standards. In complex situations, we need to consider multiple perspectives to ensure we make the right decisions. That concludes our case analysis of the standards. In the next section, we will continue our in-depth study of the CFA standards and cases to better prepare for the exam. Stay tuned.